Ladies and gentlemen, welcome to a blockbuster episode of Economy Roast, where we're turning up the heat on the US economy's wild ride. Buckle up as we dive into the seismic shifts rocking the financial world, with tariffs shaking things up like never before. Wall Street's been riding higher all year, fueled by bold bets on a rock-solid economy and tariffs that were supposed to glide by without igniting inflation. But hold on tight. New trade policies are sending shockwaves, threatening to spike prices and choke growth. Last week's data hit like a sledgehammer, shattering investors' confidence and exposing cracks in the economic foundation. From supply chain chaos to consumer spending on the ropes, the question looms: what's next for prices, profits, and progress? We're slicing through the stats, grilling the market moves, and serving up the unfiltered truth about what these tariffs mean for America's economic future. So grab a front seat row and let's fire up the economy roast. It's time to get to the bottom of this financial inferno.
The recent wave of tariffs imposed by the Trump administration on various countries is forcing U.S. businesses to reassess pricing and supply chains. Many American companies and associations are concerned that these new tariffs will further complicate global trade. U.S. businesses are grappling with tough decisions on pricing and sourcing as tariffs ranging from 10% to over 50% are set to hit multiple economies. Notably, the roughly 20% tariff on some developing Asian nations, key links in the U.S. consumer goods supply chain, is several times higher than previous levels. All three major U.S. stock indices rose over 1% on August 4th as investors hunted for bargain stocks following a previous session's sell-off and raised expectations for a September interest rate cut after weaker-than-expected jobs data. Tesla shares surged after the electric vehicle maker granted CEO Elon Musk 96 million shares, valued at approximately $29 billion. According to CME FedWatch, the odds of a September rate cut now stand at about 84%. Market participants expect at least two rate cuts of 0.25 percentage points each by year-end. The lackluster July jobs data released on Friday, August 1st, 2025, also came with significant downward revisions for May and June. The S&P 500 and NASDAQ have recently hit a series of record highs. The S&P 500 gained 91.93 points, or 1.47%, closing at 6,329.94, while the NASDAQ composite rose 403.45 points, or 2.95%, to 21,053.58. The Dow Jones Industrial Average climbed 585.06 points, or 1.34%, to 44,173.64.
A little bit of a relief rally we're seeing today. I think the market is kind of feeling pretty good that we've moved past some of the chaos of last week, a little bit of the unknown with the big revisions to the unemployment figures, and now the market is back on solid footing and feeling like all's good in the world again. Tariffs are definitely looming, and they haven't really hit the markets or the economy yet. Consumer pricing hasn't really been impacted as of yet. So I do think that is one dynamic that we can expect to impact as we move forward this year. Usually those impacts take some time to feed through the market. We had some delays because of what President Trump had done with regard to postponing some of the impacts of the tariffs. But now, as we're kind of getting some form and function to what the actual tariffs look like, 15% seems to be a little bit of a baseline, especially once Japan was locked up with that. We're getting EU numbers coming in. We're still waiting on China, who is a large exporter to the U.S. So I do expect some of those figures to start to hit as we move a little bit further into the fall here. And as a result, those prices could rise, and we could see that impacting the economy and the profitability and mostly the margins of some of the companies, which thus far have been able to absorb any impact that they've had, which have been minimal.
Sharply increased tariffs on imports from various countries and on products from industries like steel, aluminum, and automobiles have caused a surge in operating costs for many businesses. Some companies have passed this burden onto consumers. While Trump continues to push for a restructuring of the global economy with the highest tariffs since the early 1930s, Switzerland, reeling from a 39% tariff, has sought further negotiations, similar to India, which faces a 25% tariff. The new tariffs also include a 35% rate on many goods from Canada, 50% on Brazil, and 20% on Taiwan. Trump's new tariffs have created additional uncertainty, with many details still unclear. Businesses and analysts say the impact of Trump's new trade regime will not be positive for economic growth.
It's a completely ridiculous economic policy, but I would have said that yesterday.
Well, in some ways, I'm not surprised because the president likes to keep people on their toes, keep countries guessing as to what is likely to happen next. It's also putting pressure on those countries that have yet to sign a trade agreement that there will be consequences if they don't.
It was expected because he said he was going to do it on August 1st and sent out various notices to his social media platform to that effect. So in that sense, it's not a surprise, but I suppose a lot of people hoped that he would delay. He delayed the actual implementation until August 7th. So some countries will probably come in and do deals with him and get slightly lower rates than the ones he announced today. But it's not a 30-day delay. So I think for most countries, these are the rates. And for most countries, the flat rate is 15%.
Well, I think what is likely to happen because of the additional tariffs combined with the much weaker than anticipated employment report, that August once again will likely post a decline for the S&P 500.
It'll mainly affect U.S. trade, and it will increase the price on an average basis when these are fully implemented, and that takes time. But they will increase the average price of imports purchased by Americans by probably around 15%. That's a pretty big increase, and that will show up in inflation later this year. Certainly by October, November, we'll see it in the consumer prices. I think the U.S. economy is slowing down anyway, because a lot of households are heavily indebted, and business investment. I know that Trump announces all these deals, but in fact, business investment has not been good in the first half of the year because many firms they don't know what's going to happen next, so they delay. So I think we're headed for a slower period of economic growth and maybe even some drop, a little bit of recession. Not a big recession, but a small recession.
Well, the global trade as a result of these tariffs will likely end up slowing down. Yes, inflation will pick up initially, but then on a year-over-year basis will not continue to climb. But it will likely put pressure on the U.S. consumer, which represents about 70% of our economy, and could end up representing additional pressure on the global economy. So This year, we are anticipating about a 1.9% rise in real GDP and a similar number for 2026. But 2026's forecast, obviously, is subject to revision.
American consumers are going to pay. My expectation is that most countries will say it doesn't make sense for us to retaliate, because if we retaliate against the US, that hurts our own consumer, our own industry. So I'm expecting that the tariffs we see now will more or less be the pathway for the next several months until Trump gets another brainstorm.
The outlook for the tariffs is that it's really more of a negotiating ploy. They want to get the other countries to sign an agreement. But knowing the president, even if those agreements are signed, if he changes his mind, he will push to do so. I mean, if you take a look at the USMCA, the trade agreement with Mexico and Canada that he signed in his first term, obviously that was thrown out the window based on his decision, not Canada or Mexico's decision. So who's to say whether what is agreed now will be in agreement for the remainder of his term in office?
The labor market is showing signs of strain. The hiring rate has dropped to its lowest level in 7 months. The quit rate, a key indicator of worker confidence, has fallen to just 2%. Additionally, GDP data released on July 30th shows the economy grew by 3% in Q2 2025 compared to the previous year, following an unexpected decline in Q1 2025 due to a surge in imports before new tariffs took effect. However, economists warn that this robust growth masks underlying issues. Domestic private sector sales to buyers, a key indicator of consumer and business demand, grew by only 1.2%, the weakest increase since 2022. EY Parthenon chief economist Greg Dako called this recovery an economic mirage, noting that policy uncertainty, rising inflationary pressures from tariffs, and tightener immigration restrictions are starting to have a more pronounced impact on economic activity. Furthermore, after the Federal Reserve kept interest rates unchanged, the Personal Consumption Expenditures Index, the Fed's preferred inflation gauge, released on July 31st, showed prices rising rapidly in June 2025, with inflation still exceeding the Fed's 2% target. Consumer spending is also showing signs of strain, with real personal consumption rising by only 0.1% in June 2025, following a downwardly revised 0.2% decline in May 2025. Last week ended with a disappointing July 2025 jobs report, the clearest sign yet that the labor market may be struggling. The U.S. economy added just 73,000 jobs, significantly below the forecasted 104,000. Even more striking were the sharp downward revisions to job numbers for May and June 2025, totaling 258,000 fewer jobs than previously reported, marking the largest 2-month revision since May 2020. Overall, these figures paint a picture of mounting economic pressure, with increasingly clear signs that households are beginning to feel the strain as we head into the second half of the year. Economists suggest that tariffs are starting to take a toll, increasing inflationary pressures, reducing consumer spending, and prompting businesses to adopt a wait-and-see approach. Signs indicate that consumer spending is losing momentum. As real income growth weakens, consumer spending will be increasingly constrained, particularly for discretionary purchases and goods most vulnerable to price increases driven by tariffs.
And that's a wrap for Economy Roast. We've sliced, diced the latest economic twists, and it's clear the heat is on as tariffs start to pinch the US economy. From rising inflation pressures to cautious consumers and businesses hitting the pause button. The tariff tail is stirring up a storm. Will the markets weather it? Or are we in for a wild ride? Tune in next time as we keep roasting the numbers and serving up the truth. Thanks for joining us, and see you soon.